While 2020 was a record-breaking year for housing markets in many countries, including the US, for the commercial real estate sector, it was a completely different story.
In the United States, for example, the vacancy rate of office space was around 9% at the end of 2019, but increased to 17% at the end of 2020.
So it really almost doubled between 2019 and 2020. I'm Mahvash Qureshi, and I'm the Division Chief in the Global Financial Stability Analysis Division at the Monetary and Capital Markets Department at the IMF.
I'm Andrea Deghi. I'm a financial sector expert in the Global Financial Stability Analysis Division of the IMF's Monetary and Capital Markets Department.
Welcome to this IMF podcast. I'm Bruce Edwards. The pandemic has hit the commercial real estate sector hard. Lockdown and containment measures severely affected economic activity, pushing down commercial property transactions and prices in cities around the world. The latest Global Financial Stability Report takes a close look at how continued downward pressure on prices could threaten financial stability and ultimately hamper the recovery. Andrea Deghi was a lead author, and Mahvash Qureshi headed the team for the research. So what was happening in the commercial real estate sector in the lead up to this pandemic? I mean, what was the trend?
So before the onset of the COVID-19 pandemic, the commercial real estate sector had been growing steadily in many countries across the world. We were seeing prices were generally rising, and in some countries, actually, they more than doubled between 2009 and 2019 in real terms. Now, on average, the value of the sector across advanced and major emerging market economies grew faster than output over the last decade, and its size stood at about 20% of GDP at the end of 2019. And in some countries, actually, it was over 50% of GDP.
Wow.
Now, this general trend does mask some heterogeneity across segments within the CRE sector. So, for example, the retail sector in particular had been facing increasing headwinds even before the pandemic crisis due to a gradual shift in consumer preferences away from traditional brick and mortar retail towards e-commerce. This had put a downward pressure on revenues and led to some decline in the prices of these property in several countries. But by and large, the other segments, such as office buildings, industrial space, and multifamily dwellings, were doing quite well. 2020 was, of course, a very different story. And the commercial real estate sector has been one of the hardest hit sectors by the pandemic. So in the immediate aftermath, we saw transaction volumes and prices across the world drop sharply as, containment measures in response to the pandemic were undertaken that led to a complete shutdown of economic activity in many countries and reduced the demand for commercial property. Mm-hmm. And Bruce, just to give you an idea of the numbers, so on average globally, commercial real estate transactions fell by almost 40% in the second quarter of 2020 relative to the same period last year. And in some regions, such as North America and Latin America, this decline was actually over 60%.
Wow, that's significant. But had prices risen too high before the pandemic? I mean, was there any concern that these assets were, in fact, overvalued?
This is an excellent question. So as Mahvash just mentioned, commercial property prices had steadily increased over the last decade, reaching for some economies even an all-time high. But does this mean they were overvalued? The answer actually is not that immediate. Typically, a variety of simple metrics are used to assess the extent to which prices that we observe in the market are justified by the current macroeconomic environment. Mm-hmm. For example, one common measure is the capitalization rate, which is the ratio of net operating income to commercial real estate prices. So a lower value of this measure is interpreted as a sign of overvaluation in the commercial real estate market and vice versa. So if we look at that measure before the pandemic, we find that it reached its lowest level since the global financial crisis in many countries, which suggests some overvaluation in commercial real estate prices. When we look, however, at the capitalization rate as a spread or difference over the respective government bond yield, this has remained within a narrow range in the run-up of the pandemic and thus do not provide much evidence of stretch valuations, at least from a historical perspective. Since these two standard measures suggest quite a different evolution of prices, one of the main contributions of our work is to put forward a more formal model to assess CRE prices overvaluation. Through our framework, we attempt to determine, in particular, in a more rigorous way, whether actual commercial real estate market prices differ from the value implied by economic fundamentals, such as the level of aggregate demand, interest rates, or expected net operating income. Based on our model, we don't see much of evaluation before the pandemic in our sample of countries. Although I must note that here our sample is limited because of data limitations. By contrast, we observe that commercial real estate properties were quite overvalued before the global financial crisis in 2006 and 2007. In the aftermath of the pandemic crisis in 2020, we find that prices have become somewhat overvalued. And this largely reflects the drop in the fair prices because of a deterioration in underlying fundamentals, especially in aggregate demand and net operating income.
And so how are these commercial properties financed generally? And given the situation that you describe in the report with the sector struggling, what happens when investors can no longer service their debts?
Sure. The CRE sector relies heavily on debt funding, and usually bank loans provide the largest source of commercial real estate financing. For example, they constitute approximately 70% of all the commercial real estate debt in Europe and Asia, and more than half in North America. There are, however, large variations both across and within countries. In the EU, for example, the average commercial real estate lending was around 26% of the total bank lending to non-financial corporates in 2019. But in some Eastern European countries, the ratio exceeded even 50%. In the case of US, small and regional commercial banks tend to have also a much larger share of commercial real estate loans in their portfolio relative to larger banks. Beyond banks, other financial market institutions such as insurance companies, pension funds, and various types of investment funds are also largely exposed to commercial real estate. In addition, the sector is financed by commercial mortgage-backed securities, which is a type of fixed income investment backed by mortgages on commercial properties. And in a few countries, this is quite prominent, most notably in the United States and the United Kingdom. So coming back to your question, what happens when investors, for example, can no longer service their debt?
Yeah.
All in all, the large size and heavy reliance on the debt funding of the sector could imply that distress in commercial real estate can have significant implications for macrofinancial stability. A key channel for this is through bank solvency. This happens because by extending loans, lenders in general become exposed to credit risk. So a downturn in the commercial real estate market can worsen the credit quality of borrowers. And if this leads to borrowers' defaults, banks can potentially incur very large capital losses, in turn reducing their lending to the economy, and in extreme cases, banks can even default. Another possible relevant channel between commercial real estate markets and financial stability operates through the significant exposures that non-bank financial institutions have in CRE debt and equity.
You mentioned there non-bank financial institutions. Remind us what those are exactly and why we should worry about how this plays out for the non-banks.
Yeah, simply put, non-bank financial institutions are financial corporations that are primarily engaged in financial intermediation. That is, they channel funds from lenders to borrowers. But these are not classified as deposit takers. In general, they supplement banks in providing alternative financial services to individuals and firms, such as investment, risk pooling, and brokering. Examples of non-bank financial institutions include pension funds, insurance companies, and various types of investment funds. In the absence of effective regulations, non-banks can pose a risk to financial stability. In the specific context of commercial real estate, they could constitute a substantial risk, as when commercial real estate prices decline, the value of the assets held by these investors falls, and they might become less willing, therefore, or able to provide new financing to commercial real estate borrowers if the balance sheets are weak. Investment funds may also face a redemption pressure from end investors following a drop in performance, which may lead to fire sales of commercial real estate assets. Given the high liquidity of commercial real estate, the impact on prices could be significant. Another important element to consider is the role of non-banks as foreign investors. Most cross-border investments originate indeed from non-banks, which are more fickle in the face of large global shocks. In fact, what we see in the data is that in economies where the average share of cross-border investment in the commercial real estate sector was large in the pre-pandemic period, have experienced the largest contraction in overall commercial real estate activity during the pandemic crisis.
So Mahvash touched upon this earlier, but with people forced to work from home, many have moved out of the city looking for more space. Are apartment buildings and multi-family units also dropping in value?
Bruce, you're absolutely right. So what we see is that the multi-family segment or multi-family dwelling segment has also been affected by the pandemic in several countries. And landlords have seen a decline in their revenue, mainly because of lost rental income, which has led to some reduction in investor demand for these type of properties and put some pressure on their prices. However, this segment definitely suffered relatively less than some other segments that I mentioned before, such as retail sector, hotels, and offices. In the US, for example, the average decline in prices for apartment buildings in 2020 was about 3%, compared to 20% for retail sector and 7% for office space. So now one reason we believe that this segment was relatively less affected by the shock was that the significant policy support by several governments has specifically targeted the residential segment. Yeah. So going back to the example of the United States, government programs in the United States have tied much of the mortgage relief to residential mortgages, while not much explicit protection has been granted to non-residential commercial real estate borrowers. And then the implication of that has been that, we have been seeing rising funding costs for non-residential commercial mortgage-backed securities that have not been backed by government guarantees in the second half of last year, while funding costs for the residential commercial mortgage-backed securities that have been guaranteed by government agencies have actually declined during the same period, and we saw the issuance of these securities rebound. But having said that, there's still quite a bit of variation in the price behavior of multifamily buildings across cities, even within the same country. Yeah. So, for example, in the US, we see that apartment prices fell much more in New York and Chicago than they did, for example, in Atlanta and Miami. This could have been for several other factors, maybe because some cities experienced a greater economic hit because of lockdown measures. And actually what we're doing in our future work is that we are exploring the factors behind this variation in city level prices.
So with this increase in remote working, the trend is very likely to stick around long after the pandemic. What does that mean for commercial real estate investments in the longer term?
You're absolutely right. So indeed, we also see that trend of increased remote working data in the form of vacancy rates rising for office buildings, most notably in the United States. For example, vacancy rate of office space was about 9% at the end of 2019, but increased to 17% at the end of 2020. As the pandemic gets under control and things begin to normalize, we would expect then some reversal in that trend. But it's also quite possible that things don't ever go back to the pre-pandemic days, And the preferences of some employers and employees could tilt permanently toward increased remote working. These changes would imply a structural shift in the commercial real estate market that could indeed affect prices going forward. For example, in our analysis, we try to model such a scenario by assuming a permanent increase in commercial property vacancy rates of 5 percentage points, as discussed, due to a change in consumer and corporate preferences. And what we find is that, on average, it could lead to a drop in fair values by 15% after 5 years. Of course, experiences across the different cities and countries is likely to vary significantly too. For example, in regions where technological capabilities are limited or where most output and employment is generated by sectors where in-person work is essential, the switch to remote working would be less, and probably the sector would be in turn also less affected.
But Mahvash, with interest rates as low as they are and the prices falling, do you worry that too many investors will be eager to jump on bargains? How do you mitigate risk appetite while at the same time trying to stimulate demand, which is one of the recommendations you make in the report to support the sector?
So, Bruce, that is the critical question. The commercial real estate sector in general is quite pro-cyclical. And what we mean by that is that its performance is very closely linked to how the broader economy performs. And so now what we expect is that as there is a recovery of economic activity, we would see some recovery also in the commercial real estate sector. But having said that, we also notice that economic recovery across many countries in the world is still in its very early stages. And so what we recommend is continued policy support to keep financial conditions easy, which would help to maintain the flow of credit to corporates and households and stimulate demand. But as you very correctly note, easy financial conditions could indeed contribute to excessive risk-taking, fuel asset price bubbles, and lead to an increase in financial vulnerabilities in the sector. And so we believe that strong vigilance is warranted by policymakers, and a couple of steps could be taken in this regard. So, for example, targeted macroprudential policies, such as limits on the loan-to-value and debt service income ratios, could be deployed to address any such vulnerabilities. And of course, the optimal timing and the type of policy action that needs to be adopted would depend upon the country's specific circumstances, such as the pace of the recovery and the nature and extent of the vulnerabilities. Now, secondly, to ensure the resilience of the banking sector, we would suggest that stress testing exercises should be considered to help inform decisions on whether adequate capital buffers have been set aside by banks to cover their commercial real estate exposures. Finally, given the increasingly important role of non-bank financial institutions in the commercial real estate market, as Andrea explained in detail, we believe that efforts should be undertaken to broaden the reach of macroprudential policies to cover non-bank financial institutions at the earliest.
Mahvash Qureshi and Andrea Deghi, thanks so much for sharing this research.
Thanks, Bruce, for having us here.
Yeah, thanks a lot, Bruce.
You can read the full report on the commercial real estate sector in the latest Global Financial Stability Report, which you'll find at imf.org. Look for other IMF podcasts wherever you get your podcasts. Follow us if you like what you're hearing, and follow us on Twitter at IMF_podcast. Thanks for listening.